Let's start with the first one, which is the account payable. Many times they will ask you come up with procedures on how to test the account payable, or sometimes they even give a particular assertion. Right. But remember, what I always tell you is anytime you are thinking substantive testing, substantive procedures, first of all, you need to understand the balance. How does financial statement come about this particular balance? Where does it come from? Usually, your account payable comes like this. You always start with the balance you brought forward from the last year, which is the opening balance. Then, if there are purchases during the year, that adds up to it, so plus purchases. Then, if you have made some payment, then less all the payment you have made. Then that is when you arrive at the closing account payable balance. This is the balance you see on your statement of financial position. So, if you are going to audit this balance, it's not just this balance alone. You need to have audited all of this as well. And when you look at it holistically like this, then it's easy for you to be able to understand how you're going to be coming up with your test procedures. You cannot say you are fine with account payable without looking at purchases. And that is why, though we are looking at statement of financial position balances, we cannot stay away from looking at purchases. So I'm going to touch on occurrence, accuracy, and especially cutoff for these purchases. Yeah. So we're going to look at how do you test each of these items? What kind of procedures you have to come up with? By the time you think like that, you will see that you are not ever going to get stuck on number of procedures you need to come up with. And also, when they are asking you questions, yeah, which you will see when we start going into questions, you will be deliberate and specific, and you can also have clarity on what exactly they want you to do because you know what exactly we're talking about here. So for opening balance, straightforward, I always tell you, how do you get comfort on it? This one you always have to agree with the prior year auditor financial statement. So you just need to, that is all you need to do with any opening balance. You just have to agree with the prior year audited financial statement and you're fine. Yeah. So let's quickly look at purchases. How do you test for purchases? Purchases. Yeah. Going back again, it always have to do with assertions. What assertions will be critical for purchases? You'll be looking at accuracy, you'll be looking at occurrence, you'll be looking at cutoff. Extremely important. Yeah. And how do you test for accuracy of any purchases? Remember, accuracy is about the amount. Is the amount correct? All you have to do is to say you're going to select samples of purchase purchases amount from the GL and agree with relevant invoices to ensure that the amount posted in the GL is correct. Remember what I told you. When you are writing procedure, it is not just what you are doing. You must always put why you are doing it. If you put only what you are doing, you're only going to get 50% of the allotted mark for any procedure. So if that procedure is 1 mark and you say select samples of purchases amount from the GL and agree with the relevant invoices, if you stop here, you're not going to get a full mark. You're going to get half of that mark. But you must continue to say why you want to do that. And the reason why you are doing that is to ensure that the amount posted in the GL is correct. So you must always say why. And once you do that, you know that you've dealt with accuracy of that purchase amount. Right? But what about occurrence? Occurrence is, in this case, the same procedure will give you occurrence, because if you're able to trace the GL to the source document, it also gives you comfort on occurrence. So this same procedure addresses your occurrence. Occurrence will have a problem if you have a balance in the GL and you cannot see an invoice to substantiate that amount. And that means that transaction did not occur. And that would be a problem. But if you're able to trace to invoice, then you are fine to say, okay, yeah, it's correct. And in this case, you'll be saying, yeah, the transaction truly occurred. So it's the same understanding. Now, cutoff. Cutoff is different. And if you remember the way we explain cutoff is always about thinking about the year end, which is your cutoff date. And you want to be sure that only the transactions that are occurred before the year end is in the financial statement. And any transaction that occurred after the year end should not be in your financial statement. So this is your cutoff date, which is usually 31st of December. Yeah. And how do you test for that? It depends on the transaction. Now we are looking at purchases. So, which means we need to know at what point do we say purchase has taken place. So, tell me, when do you say you have a purchase? At what point? What document signifies that there is a purchase?
Goods received note.
Fantastic. GRN, good receipt note. Because we always say that our accounting is not a cash accounting, it's definitely an accrual accounting. So in that case, the day you have good receipt notes is the day you have confirmed that you have received the good. That is what this document is saying, that you have received the good. And when you have received the good, you already have an obligation to pay. So that is the point when you must recognize your liability. So which means if you want to test for cutoff for purchases, what you'll be doing, your procedure for cutoff will be to select, and pay attention, select samples of GRN dated before or on 31st of December, which is a year end, for instance, yeah. I'm called dated year end date and check that they have been recorded in the AP ledger as at year end, and select. So you're not doing one part, because what you have done now is this part. You need to also do this part before you say you have done cutoff. So, and also select GRN samples dated after year end and check that they have been excluded from APGL as at December 2024 year end. So you can see it's both sides that you are checking, not just one side. And this is your procedure always for cutoff. Anytime you
I
want to
have a
test,
question.
please go ahead.
Okay, so in some cases, it would say there is a clause that says that the client assumes responsibility once it has left the supplier's warehouse.
Good.
So, but I we know from the standards that obligation passes once the goods are received. But if the clause says once the goods leave the warehouse, so that means in transit, we are responsible, it's ours. So it kind of confuses me. Like,
Okay.
at what point do we really recognize the goods as ours?
Fantastic. Fantastic question. So, that question that you have raised is like an exception sometimes. I'll call it, it's not the general situation you always see, right? And I'm going to explain it. It's what you call free on board, FOB sales. Yeah, and I'll explain what this means to you, right? Normally, the general thing is what we have explained here, which is what we all know. But sometimes you always have an exception, which is why the nature of the contract is also important. And that is why you always need to know at what point will you say there has been a sale or there has been a purchase. For the scenario that you just painted, what has happened is that the client has accepted the responsibility to pick the good from the seller's warehouse. So this time around, it's not the seller that is delivering to the client. The buyer is the one taking the item from the seller. And in that case, this GRN will be issued upon that pickup, not on delivery, because the delivery will be deemed to have taken place at that point when the client has agreed to pick the item from the warehouse of the seller. So at that point, the seller has delivered to him at the point of pickup. And if that is the case, the GRN will be issued at that point because that is the point where purchase has taken place. If anything happens to that goods while in transit to the buyer, is a buyer's risk, is a buyer's problem, no more the seller's problem. And that is why the obligation to deliver that asset to the buyer are taking place at the point of pickup. I don't I don't know if that clarifies your point or you want to
Yes.
say more. Yeah.
Understand clearly. Thank you.
All right, good. All right. Any other question before I go ahead? Okay. Like I said, if you have any question, anyone, please feel free, stop me and we can take care of that. Yeah. So, and in that case, it's still your GRN will be used because that GRN will be issued at the pickup point. Yeah. Um, that is the way you test your cutoff for purchases. And once you do that, you are relatively cool with your purchases as you are testing AP. Opening balance is also fine. Now, payment. How do you test for payment? That is one of the easiest thing to test for. Like I always say, all you need to do for payment is to just trace to bank statement to be sure that they've truly paid. Yeah, trace to bank statement because that is the only way you can confirm that someone has received money or someone has paid money. So trace to bank statement. Yeah. And that is it for that. Now let's go to the closing balance. Now we're good with this, we're good with this, we're good with this. Now the closing balance itself, we cannot stop there. We need to test it as well. I'm breaking this down for you because your question can be tricky. They might not tell you to just come give procedures on closing balance. They can tell you to develop procedures on the purchases. Yeah, so that's why you need to know everything from the beginning to the end and not just memorizing procedures. And like I always tell you, The easiest way to fail is to memorize procedures. Never do that. You have to understand the procedures. Why are you doing it? Why is it relevant for what? Because that is all you need, right? Yeah. So for the closing balance, you always have to obtain the schedule because you can't if I say AP is 30 million, that's the closing balance. You can't audit 30 million. The first thing you need to do is to obtain the breakdown, the schedule. So you have to obtain the breakdown schedule to know makeup, cast for accuracy. I explained what casting means the last class. Casting means you're adding up. Yeah. So you cast for accuracy and agree total to the GL. So they've given you the breakdown, which is the schedule. You need to add it up, cast it to be sure that it truly is going to add up to 30 million. That is a valid procedure. Yeah. So sometimes if it's just the general balance they're asking you to audit, that is the approach you want to audit because you can't just audit a balance without seeing the makeup, right? Then, when we're doing account receivable, we're very quick to talk of confirmation, send a confirmation letter and all of that. But for account payable, it's slightly different. You don't go straight to sending a confirmation letter because sometimes the supplier, which is the person that you are buying item from, usually will send you your statement. And that's a third-party document, right? So in that case, what you want to ask for is select samples. So you want to select samples from, remember this 30 million would have been broken down into, say, 4 customers. Customer A, customer B, customer C, customer D. This one owing 5 million. Customer A is owing 5 million, customer B 10 million, customer C 12 million, then customer D 3 million, right? So you don't have to test A, B, C, D. Your audit is not absolute assurance, it's a reasonable assurance you need to give. So you are always testing material balances. So you might say, I'm testing just B and C. So select B and C, which are your samples. That's what we're saying. So select samples and request for supplier statement. So you are owing A, you are owing B, you are owing C, you are owing D. It's a payable. So we want to test payable to B and payable to C. So B would have been sending us our statement. So we want to check for that statement. So you as an auditor, you go tell the client, give me supplier B statement or give me supplier B and C statement. Yeah, so select samples and request for supplier statements of account. And why are you doing that? We want to agree the balance code per GL to the statement. Yeah. So it's similar to the way banks always send you your statement every year. Your suppliers as well, they do send their buyers their statement of account so that they can see how much they are owing and all of that. Yeah. And if there is no, sometimes some suppliers either they forget or they don't send at all, then you can also send a confirmation letter. Yeah. So you can send confirmation letter. Remember, I'm giving you all the possible procedures. Now, depending on the question, you know which one you're going to apply. So send the confirmation letters as well is a valid procedure, but not for everybody. Only you send confirmation letters for samples with no statements from supplier. So if your supplier does not send statement, then we can send a confirmation letter. Yeah. Why? To confirm the amount owed, which is your payable ledger. That's another procedure. Also, you can do analytics, guys. If you remember analytics, I told you analytics is about what? Forming an expectation. Yeah. You form an expectation, then you compare your expectation versus GL, which is your actual, and you investigate the difference. Just to give a bit of revision on that. Yeah, when we did analytics. Yeah. Your expectation can be in any way. It can be your prior year figure. It can be your, who remembers? It can be industry peer. Yeah. It can be budgets. We are doing variance analysis. It can be auditors' estimates. Yeah. All of this can form your expectation for analytics. Right. But for AP, if you want to do analytics for AP, what you usually do is auditor's estimate. And how do you do that? I mean, it's not that you cannot use prior figure as well, but it's not as efficient or as effective as auditor estimate because you know that AP days has a formula, and that is equals to your AP balance divided by purchases, credit purchases, multiplied by 365. So if you know what their policy is, which you will always know, if you don't know, you can ask for it. So based on these AP days, you know their credit purchases from the P&L account. You can independently estimate what account payable balance should be. And once you estimate that, that form becomes your expectation, then you can compare it with the GL and see whether there's a material difference to investigate. So if you want to use analytics, your procedure will be to perform analytical procedure by forming an expectation based on the APD policy and compare estimates with GL, then investigate any material difference. That's a very solid analytical procedure. That's analytics. That's still on the closing balance. You can see what you're doing on closing balance. You can do this. You can send confirmation letters. You can do analytics. Likewise, there's anytime you are testing for liability, please take note. Completeness of liability is very important. And the easiest way to do this is what we call test of unrecorded liability, because you want to see whether it's complete. So have they left some things unrecorded? Have they left some liabilities unrecorded? So you need to do your test of unrecorded liability. And how do you do this? It's a very, very popular procedure and easy. And it's intuitive as well. How do you know that some liabilities have been left out as at December 31st, 2024, when you were doing audit? How do you know that some things were left out? All you need to do is you go to 2025 because you always be doing your audit in 2025. And what do? You ask your client to give you their bank statement for January, just after the year end to March. Then here, you can select some huge payment that they made. If your client make some payment after the year end, you can ask them questions. What does this payment relate to? Tell me, I want to know. When did you incur this liability that you are paying for? By the time they give you explanation, you will know whether does that relates to this period. And if it relates to this period, then you need to check that they've actually recorded it as part of their AP balance. If not, then they need to record it. That is how to test for completeness for liability. And that procedure is called the test of unrecorded liability. Right. So let's put it in a word. Yeah. So obtain I hope that explanation is clear. If it's not clear, please let me know. I can explain again. So obtain the bank statement post year end. Select samples of material payment and inquire from the client if they relate to prior year being audited. Ensure they have been properly recognized in the right period. Simple. And that is your completeness testing. And with that, you're good with account payable. It's nothing going to be outside of what we've dealt with now. There is nothing left in account payable to understand. Okay? Akura. Okay, go ahead.
Sorry, I'm interrupting. Can you please repeat this part again, just to make sure that I'm understanding it right?
Okay.
The unreconciled liability, please.
Unrecorded liability, yeah. So unrecorded liability, what I'm saying is, for completeness, you want to check whether is there any liability that has not been recorded, which means you want to test for completeness. Have they left any liability out unrecorded? And the best way to do it is to check the payment after the year end. If they make payment after the year end, then you need to ask the client, what period does that payment relate to? If they say, the payment that we made is for a car that was delivered on 31st of December 2024. However, we couldn't process the invoice, so we just processed the invoice in 2025, and that's why we made the payment. Definitely, they've received the car at the year end, so that liability must be recorded. But they've been exposed by the payment they made after the year end. So you are always going to the subsequent period to see the payment that has been made, and you are checking that this payment that you have been made is actually for a liability for the new year. If it's a liability for the previous year, then they must recognize that liability. Yeah. So that is how you test for unrecorded liability. And we've tried to put it in a word now. And that's why I say obtain the bank statement post year end, which means after your year end, get the samples of payment, then discuss with the client to know the period it relates to. Based on the period it relates to, then you must ensure that they post it in the right period. If it relates to 2025, then it stays in 2025. However, if it was a liability that has crystallized in 2024, then they have to recognize it in their 2024 financial statement. Hope that is okay.
Okay, thank you.
Yeah, good. All right. So Accrual extremely similar to AP. However, one thing you will always note is that for Accrual, it's a step before AP. Remember, how do you come up with Accrual? If you are buying something, at the point when the item was delivered to you, that's when you have a liability, and is Accrual you first recognize for. So you're going to debit your purchases, which is your expense. And if it is asset, you debit your asset, but you credit Accrual because the item has been delivered and you have GRN. Yeah. This is what you are testing in Accrual. But when you are testing AP, remember, when we're talking of occurrence, we are tracing AP to invoices, if you remember. Yeah, look at it. We're talking invoices. That's the difference. Because when we are talking of accrual, invoices is not relevant. We'll be talking about GRN because it's GRN that creates an accrual, right? At the point when you be talking of AP is when you already have invoice, and at that point you are taking away accrual, you are canceling this accrual out, and you are now recognizing AP, which is your vendor's account. And this is an account that is ready for payment. Because when it's time to make payment, then you debit this account and you credit your bank. And this is when you pay. Right. So this is payment. This is invoicing. And this is delivery or receipt of goods or service. Right. So this is your AP or this is your accrual. However, because it's the same liability, kind of, so the testing is similar. But one thing that I will mention is the way you do your analytics. Yeah. So for accrual, the analytics is usually, I would say, your expectation for because that's what makes the difference. Your expectation, instead of using your AP days, you can't use that for accrual. For expectation, make it easy and just use your prior year for your expectation. So that's how you can use your prior year to form expectation, because usually you can expect that the prior year accrual will be similar every year. Whether it's a rent you are accruing, whether it's 2 year expenses you are accruing, you will always have that same cycle every year. And you can, it's not that you are not allowed to have difference. You can have difference. All you need to do is to speak to the management and let them explain why they have that difference. Yeah, the test of unrecorded liability as well is the same thing for accrual. You can use payment to check. So if they have made a payment, you are checking, did they accrue it at the year end? For some of you that work in finance department or that are currently working, you realize that towards the year end, your finance control, they will be chasing you for services that you've enjoyed, that you have not received invoices from. They're asking you because they want to accrue for those services because you've enjoyed them, or items have been delivered that invoices have not been given. They want to know so that they can accrue it for year end. So it's the same test on reliability. Yeah, then that would be quick one on AP and accrual.